You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes, SD War Collection, to our exclusive new line of insurance approved, TL rated precious metal safes, SD Bullion is what you're looking for at the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the Doc today at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets wrap. Well, Eric, in a thinly traded holiday week, we saw the expected smash down early in the week on Monday with gold and silver. Silver taken down, I think, about 80 cents and gold over $30. But here on Friday, in another very thinly traded day, actually some positive moves in both gold and silver. Silver spiking back above 16 during London trading. It's been suppressed back a bit throughout the U.S. session here, but closing above that $16 support level. Gold spiking about $25 intraday, touching just around that $1,200, that significant level, and then was kind of worked off of that throughout the afternoon, closing right around $11.95 here. So all in all, not too bad of a week for gold and silver in the thinly traded holiday markets. The cartel has been so traditionally fond to take the metals down on quite significantly during.
Yeah, and much to contrary expectations as well, too. A lot of people were expecting much larger declines in this period, just based on the fact that the trend was such that it looked like there really was no support, and so on and so forth from a technical analysis point of view that influences the thinking of a lot of people. And a lot of people will say, in the stacker community and beyond, that who cares about technical analysis? Well, the fact is that a lot of people follow it, and it does shape the markets. We are now just under the 50-day moving average for both gold and silver, and I think next week we're going to take them back out. And the chorus in the analyst community and people in the precious metals basically looking around saying, gee, that was pretty interesting. But now we're beginning to move the trend upward again. This is a pattern that we saw actually a couple of times in the closing period of the year, in 2009 in particular. So it really isn't that surprising, and in fact I was forecasting that we would not see gold fall below $12.55 if we were to fall in this week of prime cartel attacking, and here we are, we're bouncing back. Didn't even get down that low. And likewise, silver at $15.50 or so was demonstrated just tremendous support. There's just a heck of a lot of people waiting to buy when it would fall down into that range. So all in all, I think we're still shaping up for a pretty amazing 2015, not for good reasons, unfortunately, but the space in precious metal space has been going through a 3+ year bear market, and its time has come, given all of the shenanigans that have been going on in the various monetary games that central banks are playing, and geopolitics, and all of the other factors that support silver and gold. And in particular, we should say also that 2015 is probably going to see the first supply deficit from a mining production point of view in silver in quite some time. And that's going to really put another major upward bid on silver prices. So it's going to be a very interesting year for silver in particular, but I think gold's going along for the ride, and silver is probably going to be leading the gold dog.
Yeah, it certainly looks that way, and the other thing, the stat I was just looking at recently, Eric, was the production stats for gold and silver coming out of the ground continues to narrow. It was about 9-to-1 in 2012. It came down to about 8.3-to-1 last year, so it just continues to narrow with the actual amount of silver coming out of the ground relative to gold. And meanwhile, we're looking at, in the futures markets, a ratio well over 70-to-1.
Yeah, the gold and silver ratio is just astounding. I mean, it typically will expand in favor of gold when people have an ever-increasing fear of deflation. That's normal behavior that you'd expect to see in the marketplace, but even given what's going on with the risks of deflation and a credit crash implosion that could come in 2015. The underpinning value of silver as a monetary asset really should insulate it to a large degree, given the fact that it is now going to flip over into a deficit in terms of its production for 2015. So really interesting stuff, and we'll be talking a lot about that in the coming broadcasts. Another thing that we really should hit is that for the greatest amount of time, people in our space have been looking for capitulation to say, okay, we've seen the prices of bullion dive massively and blood in the streets, and here it's safe to say we've called a bottom. And the reality is that over the last 3 months or so, I've been arguing that we haven't been seeing that precisely because of the way in which the cartel has been managing expectations in the bullion space. And there's other like wrinkles to this too that a lot of people don't really put into their calculus, and that's that predominantly Asians do not buy mining shares. However, North Americans, and to a large extent Germans and other cultures in Europe, do buy mining shares. And when you look at the difference between how the bullion price action has been in terms of capitulation versus the mining shares, there's a story that hasn't been told. And starting back in October, we've seen mining shares just completely capitulate, and the kind of swings that we saw. I mean, if anybody in our audience would like to go back and look at any stock in the mining space, the precious metals miners, that is, on December 19th, check out the volume. I don't care what stock you pick. Go pick whatever you want. Take a look at it, or GDX for that matter. It's astounding. And, we had periods back in October, November, where we had the same kind of thing. In any given 1 week, you'd have volume that would surpass the volume for the entire the entire year in many a stock. So, the capitulation, folks, has already happened. It's just that most people in our space haven't been looking in the right direction. And mining shares in particular are probably going to scream in January. And even if it isn't within a January period, I think that their outperformance over gold and silver is going to be far more than what you would typically think of when it comes to your expectations for mining shares having greater leverage. And all of that also speaks to the wisdom of getting exposure to that space. I'm not going to name specific stocks because the Securities and Exchange Commission would come down on us and get really nasty. But suffice it to say that there is a role for mining shares and a hedge portfolio against uncertainty. I mean, it's not the kind of thing that somebody who has a minimum amount of free, unencumbered net worth, once you're out of debt and maybe you have 50,000 or 100,000 or whatever that you have in savings, it really isn't necessarily a foregone conclusion that you can conclude that it's wise to do mining shares as part of one's portfolio. But if you have net worth beyond that, the hedge value, the insurance value of mining shares actually has a place. And this is a minority opinion amongst the stacker community, to be sure, but even in some of the more conventional communities within the precious metal space, people are skeptical of this kind of thinking because it's a paper asset. However, if you have the shares in your personal possession or outside of street name in the corporate registrar of that is being used by the treasury of the corporation, it's out of the banking system. Those shares are a title to a percentage of ownership of the assets under the ground and the infrastructure needed, the hard assets needed, like capital equipment and so forth, to pull it out of the ground. It's a hard asset. And during the 1930s, the mining shares performed stupendously. And this time around, there is no necessary guarantee that the United States government won't confiscate gold or make it illegal. They're not going to go door to door, and they're not going to be able to have the success of pulling in gold as they did in the 1930s, even though they probably only were successfully able to get maybe 50% of the gold that was out in the public's hands. And a great deal that went to Europe, too, as well, as people it got wind of the program and basically front-run the law of trying to pull into gold. But the fact remains that the government could easily do excess profit tax on gold, and transactions at coin stores will be very difficult to execute. And maybe they say 90% of one's profits on precious metals need to be paid in taxes as a way of supporting the dollar. And in that scenario, it might be that mining shares would only see 50% or whatever. So I mean, just from a diversification point of view, there definitely is a role for someone of substantial net worth to look at mining shares as but one portion of diversification. And we're a bullion-based company here. We're telling you this because it's the right thing to think about. It's something definitely that you should consider. It's not in our best interest to say this, but we're saying it because other bullion companies don't say it, and that reason was enough for us to point out the value of the hedge and insurance potential for bullion. So I haven't talked about this in a long time, and I'm sure there will be a lot of people who leave comments after we post this recording, and they'll have their feathers ruffled a bit. But so be it.
The valuations on a lot of the shares are really comparable to that 2008, 2009 panic lows we saw. GDXJ is down 50. Right now, it's 50% off its 52-week highs, and it's I think around 80% off of its 2011 highs. Several of the junior mining firms I follow are 80 and 90% off of their 52-week highs, and well over 90% off their 2011 highs. And again, we're not talking about $200 an ounce gold right now. We're still talking about $1,200 an ounce gold. So the valuations comparative to the price of gold right now are very comparable in a lot of the shares to the trough bottoms in 2008, late 2008, early 2009.
Yeah, and it is definitely tricky to pick good miners. You have to know, what they're doing and the type of management, the locations geographically of their properties, and how much political risk is associated with that. And I mean, the list of risks that are associated with mining companies are long, and there's definitely a case to be made that bullion is the easy way out for insurance purposes. An ounce of gold is never going to make a dumb business decision that bankrupts a company. It's just an ounce of gold. And silver is never going to be worth nothing because it has intrinsic value. I mean, those properties of bullion,
they're not going to go off the board.
Yeah, those properties for bullion and in terms of insurance are solid. But there are other risk factors that impact bullion alone, and you never know what governments will do. And the majority of the oligarchy, for lack of a better way of putting it, owns a huge amount of stock. And if we see some kinds of moves against equities, it will impact their interests as well too. So, for diversification's sake, it's wise to own some segment of shares as a percentage of your overall allocation to precious metals.
Well, we were trying to have a brief show today. I know we do want to cover the topic of China backing up Russia and this week's recovery of the ruble as well, Eric.
Yeah, the dynamic between China and Russia is pretty profound. I mean, basically, China is acting as a backstop that's going to protect Russia to a very large degree. When people consider that central banks, the Fed, the ECB, the Bank of England, the Bank of Japan, did currency swaps amongst each other to the tune of at least $30 trillion over the last couple of years, you can kind of wrap your mind around the degree to which currency swaps can support an economic system. I mean, that single dynamic between all of the central banks printing up their own respective currencies and then swapping them off balance sheet and largely having limited impact to relative FX cross rates is a very powerful tool, and there's no reason to doubt that China and Russia could very easily execute a currency swap in the order of about $1 trillion that would entirely enable Russia to backstop any further aggressive moves against the ruble. And on top of that, the ruble has basically stabilized. I mean, it's not declining at a rate anywhere near what it was doing in the last month and a half or so back, and in the latter part of November in particular. It bounced a bit already. It's down a tiny bit today, and frankly, I think that the programs that Russia has been putting in place to enable its central bank to more aggressively deal with speculators, including the basic fact that now speculators have to factor in a heck of a lot higher level of interest carry to execute their foreign exchange trades and whatnot, have a lot of the piggyback attacks. When hedge funds see governments leading the way, sometimes they'll do piggyback trading, and I think that has a large part behind what happened to the ruble and its really, really quick decline, as well as oil. I mean, we noted in the last week that oil had declined at a rate faster than in the 2008-2009 crash, and that kind of thing happened predominantly because speculators were piggybacking on what was basically financial warfare coming from the West. So, if people think that Russia is just going to roll over and die, and that their economy is going to implode, and that Putin is going to be kicked out of office because of inflation forces making people in Russia really discontented and protesting, and colored revolutions coming to Russia, all of that kind of thesis, which happens to actually be part of the thinking of the neocon faction in the United States and beyond, all of that thesis is just nonsense. It's not going to happen. And the Russian people have been through just enormous pain historically in many chapters in their history, including as most recently in the 1990s, where, and this is a story that very few people in the West actually are aware of, millions of people died in Russia from the transition and crash of the Soviet Union and the oligarchs and the corruption that came in under Yeltsin, and their internal economy just basically being a basket case for some 7 years or so. And part of the reason why Putin is so popular is that he helped bring some stability to the country. And, yeah, he's corrupt. Yes, he's an oligarch. Yes, he's worth tens and tens of billions of dollars. But he's a nationalist, and he cares about his own countrymen. And that's more than we can say for a lot of the leaders that have been in our governments in the West. So, this is going to be a big story in 2015 because the warfare salvos coming from the West directed towards Russia are not over. It's going to get ugly, and there will be periods where the West will try to advance yet more aggressive actions against Russia, but at this stage of the game, Russia is no longer just rolling over. So if you thought that 2014 was interesting, now they're putting their stakes in the ground, and Putin is actually drawing his own red lines in his own way. 2015 is going to shape up to probably having even more geopolitical volatility because of the hubris of the West. What unfortunately is happening in the West is that we're not recognizing the leaders who are advocating for the policies that we see coming out of the West are not recognizing that the thesis operating is just bankrupt. They're not going to be able to achieve what they're trying to achieve. So that's really the takeaway, in my opinion, from what we saw with this relationship expansion with China and Russia, and this feeds right into the acceleration of the change of the dollar reserve status and trade status, and I believe that in 2015 we're going to see some very major milestones along that path, including the IMF even being more aggressive and antagonistic against the United States and in turn many European shareholders of the IMF. I don't think we're going to see the dollar lose its reserve status in 2015 in total, but we're going to see a big part of it weaken and more visibility on the stepping stones to the process of it ultimately losing its reserve status. And it will have to be a multipolar type of world, and in 2016 probably is when the end game completely plays itself out. So we'll see. And another factor that fits into this is that, this whole illusion of our economic engine doing just fine and recovering from 2019 has largely been a mirage. And we have yet one more really juicy example from a statistical point of view, where we had the United States release its most recent revision to third quarter gross domestic product growth, coming in at an annualized rate in excess of 5%. But when you look under the hood, the vast majority of that growth was predicated simply on consumers having to go into savings or debt to fork over more money to pay for health care. And the majority of the growth in gross domestic product registered for the third quarter, if you even believe the numbers that the Bureau of Labor Statistics put out, was Obamacare spending. I mean, it's like the broken window fallacy of Keynesianism all over again. I mean, you get a good earthquake, destroys lots of buildings and requires lots of new building, and we call that a good thing? I mean, yeah, earthquakes, tornadoes, and Obamacare have expanded GDP. How wonderful is that?
Shaping up for an interesting 2015 here. Again, we had closing out the week here, gold and silver up on a positive note. We do have, once again, stocks are rolling over into the close. Oil's down back below 55. And personally, going back to the mining shares, I think once the new year starts and all of the panic selling as well as the year-end tax selling exhausts itself, and everyone kind of looks at things anew in 2015, when you're talking of gold prices around 1,200 and oil prices heading towards 50 and perhaps below, that's one of the main input costs for the mining firms is oil. So it definitely shaping up for a positive first quarter, particularly for the mining shares, even without gold and silver bouncing, which I think Eric and I are both looking for here in the first quarter of 2015. So we'll keep an eye on our markets. Again, next week, should be a somewhat of a subdued trading week with the New Year's holiday in the middle of the week this week, as Christmas was this week. Now, one other thing we wanted to advise readers of this week, I think it was it Tuesday, Eric, that the news doctors was taken off the interwebs?
Yeah, I think so.
Tuesday, for regular readers, notice that the news doctors was taken down and wasn't accessible until, I believe, early Friday morning when we finally got it back up. Good friends at the HostGator, who is hosted Silver Doctors for quite a while, no longer, but they did still host the news doctors. They simply took the site down because the growth was exceeding expectations and the shared server, so rather than contacting the Doc or Eric or anybody at the team that we needed to pay for enhanced servers, they simply took us offline. So if anybody's interested in a new website and looking for a hosting service, we certainly wouldn't recommend HostGator, but we successfully migrated everything over at the News Doctors over to a new hosting company. We're back up and running here on Friday. So I think we'll wrap the show up there with a bit of an abbreviated show this week for the holiday markets. So for the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Market.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.